And I wanted to talk about something we've done here in class a couple of times, but I want to go into a little bit more detail about why and what we're doing. So I just pulled up a stock here, SPG, and this is a REIT, and you can see it's traded pretty flat for a long time, and then the COVID crisis happened, and we got some real big choppy movement. And you can see the implied volatility is down in this area for a long period of time. It pops up really big right here and then drifts back. And now we're right around 50 on volatility. But none of these volatility readings before the COVID crisis are even above 50. Okay, so my question for you guys is, SPG moved big during the COVID crisis. In the future, is it more likely that SPG will go back to pre-COVID volatility, or is it more likely that it will continue to move as it did during the crisis?
Pre-COVID.
What do you guys think? You think it's going to be pre-COVID? Pre-COVID. Anybody disagree with that?
What's the business of SPG?
It is a REIT. They make money off of collecting rent.
Oh, pre-COVID.
Yep. All right. So everybody's of that opinion.
I don't think there's going to be a new. I think there's going to be a new norm.
A new norm. Okay.
Yeah, new norm.
So do I.
So we've got a couple of people. So most people think that it's going to go back to pre-COVID, but it might be a new normal. All right. So here's what I want to show you. SPG's done this before. We had a crisis in 2008, right? The financial crisis, which specifically was affecting real estate. And we got the same implied volatility reading. We got one spike up here above 150, and then stock slowly returned back to normal, and volatility got below 50. There was a couple blips right in here in 2011, and then it got below 50 here. So we have an example of another crisis happening that affected this specific market, and it goes back to their profit margins and how they make money and what they earn. So in this case, it looks like, I think it's a safe assumption to say that volatility is likely to go back below 50. All right, and right now we'll go into SPG here. And we're at 45.70 right now. So if this came up on my list for straddle trades, which some of these REITs have recently, not specifically this one, but others have recently, you can see that we got some fat tails out here. But in this case, it's not unreasonable on the price. But we could go out to May for our options.
You're in the
It's going to be the cheapest.
You're in the way.
What was that?
You're kind of in the way.
Oh, I'm sorry. Thank you. We're going to go out to May on our options because they're about the cheapest according to the term structure. I'm going to adjust this to go out to May as well. And that's 4 years of data. And it looks like they're priced about right. They look kind of fairly priced at this point. If I go like this and change to pre-COVID data, if I'm going to go back and just say pre-COVID data to look at how the stock performed relative to the current prices, that's a completely different picture. That says these options are extremely expensive. If they're going to go back to the way they were before the COVID, these are very expensive options. They're not even just priced right. They're expensive. Okay, so if we go here and look at those May options, let's say we were going to buy a straddle on this. Price is at 113.92. That's closer to 115. So buy a call, buy a put at the 115 strike. And here it's telling me that it's just a few cents cheap relative to the FOV value, the net debit versus the FOV value. So it's a little bit, really small, cheap, but mostly fairly priced, which is what we just saw in that MDM graph. The options are priced pretty fair for the way the stock has been moving recently. So the problem is, what if the market conditions, if we have that big collapse, if our expectation is that we're not going to have this stuff in here going future, even if we're having a new normal, even if we have a new normal and volatility is going to hover in the area that it's at right now, it's just not going above here. Let's say right now the volatility it's low compared to this last year, but let's just say that it's high for in the future. Okay, we can do conditional sampling, and this is what FOViv is when we go here to this feature right there. FOViv, it's going to do some conditionally sampling. And by default, it's just saying when volatility is higher than it is right now, how does the stock behave? What was the distribution when in circumstances when volatility was higher? And what were the circumstances? How did the stock behave when volatility was lower? And what is the fair price of that option at this expiration for that time period? So 21.35 is the current net debit. 21.53 is the fair price if the stock behaves the way that it has over the past 4 years, including the COVID crisis. But if we say volatility is probably going to stay under where it is right now, we get conditional sampling, and it says that this option shouldn't be worth $9.10. In the FOViv down column, it says it should be worth $4. That's the fair price if volatility is going to stay under the point where it is right now. Over here on the put, it shouldn't be $12.25. It should be $5. So each of those options should be less than half the price that they currently are when we do some conditional sampling. And so this is what FOViv is designed to do, is it's designed to stress test or give you some other expectation other than the way the market has just performed in every circumstance over some period of time. It's giving us how it's performed based on a volatility rating, a volatility condition. And you can actually go up here and put in custom volatility. So if we could say, if we went back and looked at that year before COVID, and we said that volatility looks like it's actually closer to 20, around there. I'm just scrolling over and getting an idea of about where it sat for a while. So I could go and put in a custom volatility in here and say 20%. And then run. And I can change my start date on my analysis as well, because I'm taking at least the last year out of this, because that last year has been above that price anyway. And so that 20% volatility takes our fair value down to 3.5 here and a 462 there. So these options are priced based on the activity that we've had in this last year. And is that going to be the future? I have no idea. because there's a lot of variables that you got to throw into the mix, that things might be changing and rents could go up and they might be more profitable, which will allow them to have more money out of this. We just don't know. We just don't know. If they're more of a commercial business, if most of their business is more commercial related, then a lot of their businesses might not be able to pay rent higher than what they've been paying in the past because of this crisis. If they're doing if they're doing, home rents, those might not go down, and people have to have a place to live, and so they figure out how to pay. And rents go up and they stay up, and maybe that helps them do better. I just don't know. I don't know the details on this specific company. I would probably dive in if I really wanted to do a trade on it, but I'm just avoiding REITs altogether right now because the past year has been more volatile, and I don't think that it's going to stay as volatile as it has been. I think that it will probably come down at least some. And so when we're doing straddle trades, we're doing non-directional trades that make money when the stock makes a big move. And if we pay too much for those options, our break-even points get pushed out further. And so we need the stock to make a bigger move than is likely to happen if volatility goes down. So that helps us identify which trades we don't want to do. Now, if the company was a different company, that it was actually making money during the COVID crisis because people are buying the product, there was a lot of companies that sold goods to grocery stores and things like that that did really well during the COVID crisis. So I might have the opposite view on some of those companies going forward because things are changing a little bit more back towards normal. You just got to think about it. And the cool tool here is that FOViv lets us analyze the trade on our expectations, what we think is likely going to happen to the volatility for that particular stock based on everything that we know about them. So that's my hopefully helpful tip for you guys today.